Good afternoon and welcome, ladies and gentlemen, to the Wednesday Lunchtime Drive Through on Wednesday, June the 8th, 2022. Cannot believe we're almost halfway through the year. Can you believe that? Today, it's kind of a fun topic. Sometimes we have really serious topics. I do like to mix it up a little bit. Today is a little bit more of a fun topic that I wanted to share: demystifying common financial terms. And these could be anything from actual terms, actual words that describe what's going on, something in the market or in the economy. Acronyms in the financial industry, they love their acronyms. And then also just jargon, words that people like me throw around all the time. And we just assume that everybody knows what we're talking about. So I'm going to share some of the ones that are more common that I get questions about. And what I would like to encourage you to do is, if you have heard one and you want to share that, and I'll share it with the group, or if you just want to ask, hey, what does this mean? I've heard the term HELOC, HELOC. What is that? It's a home equity line of credit. Okay. Share that with us here. You can post that down in the chat or the Q&A button down below in the little toolbar there. Any question that you want to ask today, please feel free to do so. So let's move on. So this is kind of a quote that's attributed to Mark Twain. I am probably paraphrasing here, but he said, "Don't let your education interfere with your learning." And obviously what he means to say here is that just because you're really smart and you've got a lot of education, or just because you've got a lot of education, does not necessarily mean that you're really smart. It just means that you're really good at going to school for a long time. So if you've got a college degree, I don't want to, please, I try not trying to insult you. I've got a college degree too. The point is that learning does not stop once you get the college degree, right? So don't let education get in the way of continuing to learn and understanding that most people prefer simplicity. We prefer simple language. And the finance industry, probably more so than any other professional industry that you're going to interact with, maybe outside of the medical profession, I guess, and including advisors, they love using complex words to describe things. In some cases, it makes them feel really smart. Others, they're just not in tune with how the rest of the world talks. There's a ton of jargon out there that gets thrown around. There are acronyms all over the place, like I said. So you can, as a very well-educated, very intelligent person, you can be made to feel like, oh, am I dumb? Am I missing the boat here? Because this all seems kind of complicated to me. I don't even know what this is. Should I? Most of these terms are not that complicated. And so that's why I want to demystify them, so that if you've ever been confused by any of these terms, now you'll know what they're talking about. So let's first talk about some common financial terms. And as I said, if you think of one, you want to share it in the chat or the Q&A, please do so. So here's one: recession. This is a word that's being tossed around a lot, okay? It's being talked about a lot. In fact, recession, or the fear of it, is what's causing the market to have a rough time right now. So a recession has traditionally been defined as 2 consecutive quarters, so back-to-back quarters, so a 6-month period of negative economic growth, meaning instead of the economy growing positive, it's negative, it shrank or it receded. The problem with this definition is that it is an overly simplified definition. It's common in the media, and you hear a lot of people talk about it, but it does not necessarily delve as deeply into what goes into that. There's often a lot of perspective required. For example, the first quarter of this year economically was negative 1.4%. So you would look at that and say, wow, our economy shrank 1.4%. But if you dig a little deeper and you realize our economy did not shrink, in fact, it grew. But what also grew were our imports from other countries. When you hear about the word recession, it is measuring our gross domestic product, our internal domestic US economic output. And in the first quarter of this year, the economic output could not keep up with the demand from consumers. So where do we get the additional goods? We have to import it, and we export less. That is a negative against our overall economic report, and therefore made it look negative. Recessions can sometimes be a nice reset for the economy. You might be thinking to yourself, really, Damon, you're saying recessions are a good thing. I'm saying that recessions, when they happen for a reason. Economic expansions do not die of old age. All right. What do I mean by that? I mean, if the economy is just left to its own devices and just kind of goes along, it will continue to grow. That is its natural set point, is to grow. However, what ends up happening is sometimes the economy grows too fast. It gets overheated. So recessions usually start because the economy gets overheated, it's growing too fast, inflation goes up, and to fight back against that, interest rates go up. Recessions usually start because interest rates go up. So a recession is essentially a slowing down in spending from us, consumers. It's a slowing of company growth. It's a slowing of employment. It does not necessarily mean an economic collapse. That's what most people think of. In fact, what most people think of when they hear recession is the financial crisis of 2008. That event is burned deep into all of our psyches because it was cataclysmic. And very few people alive during that time had experienced anything like that. So most recessions are not like that. In fact, the average recession only lasts, a few quarters, basically, maybe a year. All right. But that's what a recession is. Let's talk about a bear market. So the words recession and bear market are often used interchangeably, but they're not the same thing. Recession describes the economy. A bear market is a term we used to describe the market, the stock market. It's traditionally defined as a 20% drop in the market from a high point. So for example, right now, the S&P 500, which is the index that most people look at to broadly define the US stock market. Right now, for the year, it's down about 13%. Now, earlier in May, there was one day where we briefly touched a minus 20%. So we entered a bear market officially in May of this year. Now, it just so happened that on that same day, the market rebounded enough and did not close at minus 20%. It closed at around minus 18, 18 and a half, something like that. But a bear market is defined as a 20% drop from a high point, which our high point, the most recent high point, was January of this year. Now, how long does a bear market last? Well, if there is no recession, and that's the thing, not every bear market is accompanied by a recession, and not every recession is accompanied by a bear market. They are independent things. They often move along with one another, but they don't always have to happen at the same time. The average length of a bear market without a recession is 7 months, and the average length of a bear market with a recession is about 15 months. And it's also important to distinguish a bear market from a correction. That's another term you hear. A correction is a less severe situation. A correction is defined as a 10% market decline. We get those pretty frequently. A bear market, generally a bear market happens on average every 2 to 3 years. So every 2 to 3 years, we will get one decline of 20% or more in the market from a high point. Corrections, we could get, it's not uncommon to get corrections 2, 3, 4 times a year. That just happens. Now, here's what's interesting about a bear market. People are afraid of the recession, right? And that's what's causing the market to dip like it is right now. The fear of a future recession. You see, the economy measures what happened in the past. The market measures what we believe about the future. As a result, the market tends to move ahead of the economy. So right now you've got the market right here, but you've got the economy up here. Our economy is actually very strong. I mentioned that a bear market with a recession is about 15 months. Okay. The bear market usually precedes the actual recession, so that people are anticipating a recession, and as a result, the market comes down. But by the time we actually get to the recession, the market is usually on its way back up. Why? Because people think, wow, the worst is over. It takes time for the recession to express itself, but by the time we are in a recession, the damage has already been done. It's in the past, but the market is measuring what we think about the future. So if you look at what's happening right now as this kind of movement, what does that signal? It could indicate that we have actually neared and maybe even touched the bottom of where the market's going to fall prior to the recession. So the market is usually a leading indicator of a recession and is typically on its way back up by the time we actually enter a recession. I think that's kind of interesting. Most people think they go hand in hand. They do not. They move differently from one another and sometimes in opposite directions. Here's another one: equities versus fixed income. You hear this one a lot, and I get lots of commentaries. So does Victoria. We watch a lot of videos. We read a lot of white papers so that we can come to you with information about what's going on in the market. And one of the common terms we hear is equities or fixed income. Equities is just another word for stocks. If you have equity in something, when you have equity in your home, the equity in your home, the value of your home versus what you still owe on it, that difference is your equity, what you actually own. The bank owns some of that value and you own some of that value. When you purchase a stock, that represents an ownership interest in the company. You have an equity position. Fixed income is just bonds, because the income references the interest that the bond pays. Economists and portfolio managers love using these words. I can't sit on a single webinar without hearing people blurb out the equity markets are blah, 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 and in fixed income markets. I'm like, can you not just use the word stocks and bonds? What's so hard about that? Everybody understands those words, stocks and bonds. You may very well understand equities and fixed income. In fact, you may be hearing some terms here that you're like, Damon, I already know all this. That's fine. Most people don't, because we get questions all the time. So anytime we send out a newsletter or anything that has these terms, I change the terms. I change equities to stocks. I change fixed income to bonds before we send it out, because that's what most people understand. Okay. Here's another one, PE ratio. If you want to sound really, really sophisticated with your friends, use the term PE ratio. You'll amaze your friends. What is a PE ratio? That stands for price earnings ratio. And you see this associated with stocks, individual stocks. What the PE ratio or the price earnings ratio is, it's a ratio or a fraction that compares the price of a stock to its earnings, the earnings that the company that the stock represents generates. So for example, you want to go out and buy Amazon, all right? What is its price earnings ratio? You look at its price divided by the earnings that Amazon brings in as a company. That's going to spit out a decimal point, and that is its PE ratio. I don't actually know what the PE ratio of Amazon is right now. But what does the PE ratio represent? How can you use that to invest? Essentially, what you're looking at is if the price of a stock relative to the earnings, so price divided by earnings, if that number, that decimal that is put out, if it is low, that indicates a stock that is relatively underpriced. It's underpriced in the market relative to the earnings that it generates, and therefore is on sale. It's a bargain. You can buy it at a bargain price. Right now, if you look across the spectrum of stocks available because the market's down, their earning potential is still very strong because consumer demand is strong. But right now, many prices are depressed. So we have a lot of low price to earnings ratios, meaning that there are many stocks that are at a discount right now. They are on sale. If the ratio is higher, well, then obviously it's the opposite. It means the stock is overpriced relative to the earnings that it puts out. All right. So the lower a PE ratio is, the more affordable that particular stock is relative to its earnings, or the more affordable it is in the overall market. The higher that ratio, the less affordable it is. We can even measure the price earnings ratio of the entire stock market. Generally, the stock market trades at about 16 times its earnings. Okay, so the price of the S&P 500 is usually priced 16 times higher than its earnings. Most people consider that to be a pretty healthy balance of price to earnings. When that PE ratio goes above that, into the 20s, you're looking at a market that is considered overpriced. Okay, it's a high point, and if you're trying to bargain shop, might not be the best time to get into the market. If it's under that or very close to that, that represents a market that could be on sale. And as I said, right now, you're seeing a lot of price earnings ratios that are very low because the market is down, but the earnings of those companies are still pretty strong. The future earnings of those companies looks very strong. All right, let's talk about some jargon. I don't have as many of these. Headwinds and tailwinds. Okay, you probably have heard these terms before describing impacts to the market, the environment that the market is currently working in. And this comes from the aviation industry. All right, so if an airplane is flying through the air, there's always air, atmosphere, pushing against this way and that way and from all sides against the aircraft as it moves through the air, right? Well, we can apply these same kinds of terms. And if a plane has a tailwind pushing on its back, what does that mean? It's pushing it forward. And as a result, the wind is giving a boost to that airplane, and maybe it uses less fuel, it gets to its destination faster. If there are headwinds pushing against it, well, now it has to work a little harder. There are negative forces pushing against the aircraft. Maybe it uses more fuel, maybe it takes a little longer to get there. So headwinds as it relates to the market are factors that are pushing against the market, environmental forces pushing against the market, keeping it from moving forward. Tailwinds are factors that are supporting the market. So what are some examples of headwinds? We're seeing many of those right now. Inflation. Inflation is a major headwind pushing against the market, keeping it from where it wants to go, which is up. Rising interest rates is another one. Fear is a headwind. What about tailwinds? What pushed the market forward? Falling interest rates, rising investor confidence, growing corporate earnings. Those are forces that are pushing the market up. And at any given time, there are always headwinds pushing against the market and tailwinds pushing it forward. And these things are constantly in a back and forth struggle. So that's what, and I clearly did not change my little thing down here at the bottom, so I apologize for that. All right, headwinds and tailwinds. Standard deviation. Ooh, this is one of my favorite ones. And I hear tons of financial analysts and economists who love to use the term standard deviation as though we all took an upper level statistics course. Maybe you did, but most people didn't. What is standard deviation? That is the range of loss and gain that a given investment typically experiences, over a year or some period of time, usually a year. So you can think of this as the risk range, okay? So let's say that a given stock at any given point in time experiences a range of risk that could be anywhere from a loss of 10% up to a gain of 15%. That is its range. And so that is one standard deviation, all right, from here to here. 2 standard deviations would be minus 20 to plus 30. All right. And the further out you go, the less probable those scenarios are. This is where, if you did take a statistics course, you get that standard bell curve, okay? And most of the occurrences are going to fall within the broadest range, and then you've got the tails that are the extreme positive and negative ends that don't usually happen. Most of us are not into statistical analysis. So just think of standard deviation as risk. If you ever hear the word standard deviation as it relates to a stock or some kind of an investment, that is its range of risk, and that helps you to gauge whether or not it falls within your desired range of risk. And if it doesn't, then you don't buy it, or maybe we make some changes to your overall portfolio. As I said earlier, if you've got a specific term or a financial word, jargon, phrase, acronym that you want to share here or you want to ask about, please put it down in the chat or Q&A. Let's talk about some common financial acronyms that you will likely run across. And these are by no means an exhaustive list. A REIT, R-E-I-T, stands for Real Estate Investment Trust. Many of you invest in these right now. A REIT, or Real Estate Investment Trust, functions like a mutual fund. In fact, many of them are mutual funds. Whereas a typical mutual fund would track a basket of stocks or bonds, a REIT is tracking a basket of real estate holdings rather than stocks or bonds. And these real estate holdings could be office buildings, and people rent office space and they pay their rents. The REIT owns the building. However, you receive some of the income off of those rents when they're paid. Same with mortgages. There are REITs that invest in single family dwellings, some that invest in apartment complexes, duplexes, high-rise condos, whatever. If you're looking to get into real estate, but you don't want the expense and the headache and the time of having to go out and find a property, hire a management company to manage it for you, deal with all the maintenance, you don't want to be a landlord, but you want the benefit, that income that real estate can provide, then people often go for a REIT. It's typically a low cost, low headache way to invest in real estate and to generate some income. In fact, that's why REITs are pretty popular, especially among retirees, because REITs, unlike a lot of other investment options, are required by law to pay out 90% of their income annually to their shareholders. All right, so usually they pay annually, but they can pay more often. Sometimes they pay monthly, semi-annually, but at least annually they have to pay out 90% of their income to their shareholders. And what I mean is by their net income. All right, so if they didn't generate anything, then you're not going to get a dividend. You're not going to get a payment. But if they did, then you'll get a payment of some kind. ETF, exchange traded fund. An exchange traded fund functions like a mutual fund. So you can buy a mutual fund, American Funds, Growth and Income Fund, whatever. That mutual fund is going to invest, again, in a basket of individual stocks or bonds, and there's a fund manager that manages that. An ETF is the same type of concept. You go out and instead of buying all the individual securities or the individual items, you go out and buy one fund that invests in those items. But unlike a mutual fund, which is typically investing in individual companies or stocks or bonds, an ETF is generally tracking something like an industry or a commodity or possibly an entire index rather than individual companies. So for example, there are ETFs that track the oil industry. There are ETFs that track utility companies, manufacturing, transportation. There are ETFs that track the gold index. Okay, the ETF for gold, GLD, that's a common ETF that a lot of people like to buy into. Materials, I mentioned that. The S&P 500, you can actually buy the entire S&P 500 index through an ETF. The ticker symbol is SPY. And if you purchase those shares, if you purchase that, you can expect those shares to move right along with the S&P 500 because it's tracking the index. So ETFs allow you to diversify a bit, typically by investing in some more alternative investments that you might not have in mutual funds. So in your mutual funds, like in your 401k, your IRAs, things like that, you're probably going to have more traditional investments, stocks, bonds, things like that. ETFs can come into play when you're looking to add on some alternative exposure. And also, ETFs are a good way to purchase small and medium-sized companies. It can be quite expensive, well, maybe not expensive, but it can be difficult to go out and build a portfolio of small cap companies or mid cap companies, buying them individually. Often there's not a lot of research out there, and a lot of them are not publicly traded on the New York Stock Exchange or something. You have to go to the over-the-counter market or the pink sheets. There's another term, pink sheets. Why is the over-the-counter market called pink sheets? Many years ago, they used to print almost on a daily basis a big book of stocks that you could buy that were not listed on the big board, the New York Stock Exchange, something like that. And the paper that those were printed on was pink. So the pink sheets. Anyway, you can go out and you can buy ETFs that invest in these kinds of things. And many of those are found in the over-the-counter market. NAV, net asset value. Net asset value is something that you're all familiar, or you're familiar with it, but maybe you haven't heard the term. Essentially, the net asset value is the price per share of an asset, usually a mutual fund or an ETF. So for example, if you own mutual funds inside of a 401k, an IRA, whatever, if you go and look up that ticker symbol, usually it's a 5-letter ticker symbol. When the screen comes up on your computer, you're going to see up at the top NAV. That is its price. That is the value that it's currently priced at on that day. And if you want to buy shares of that fund, that's what it's going to cost you per share. And the net asset value, unlike a stock that changes in real time throughout the day, the net asset value of a mutual fund resets at the end of each day. It's recalculated each day. It's recalculated based upon the underlying value of the stocks or bonds that it's buying, but it's also recalculated based upon the people who buy and sell. So when people redeem their shares, they sell, there are fewer shares outstanding, right? Fewer shares outstanding boosts the value of the mutual fund because it's not as diluted. When people buy shares, it dilutes the ownership more and lowers the net asset value. This movement of the net asset value of your mutual funds based upon people buying and selling has a name. It's another term called redemption risk. And other people in the fund selling their shares can actually impact the value of the shares that you continue to hold on to. So not a lot of people think about that, but it is true. It's also the reason why you could, in a given year, recognize a taxable capital gain in your taxable account, even if you personally do not sell any of the shares of your mutual fund. Why? If other people sell their shares, now there is a gain for the overall fund. How is that gain spread, or how is that gain recognized by the mutual fund? It is shared equally and spread across all remaining shareholders. As a result, it is possible for you to get a 1099 because you have recognized a capital gain in a specific year, even if you personally did not sell any of the shares that you owned. Again, redemption risk can generate this. You're not going to have that inside of a tax-deferred account like an IRA. All right, and finally, here's another one, NASDAQ. Everyone has heard of the NASDAQ index, but what exactly is NASDAQ? Stands for the National Association of Securities Dealers Automated Quotations. This has actually been around since the early 1970s. And prior to that time, if you wanted to get in the stock market, you had to pick up the phone and call your stockbroker to go out and place a trade for you, especially if it was a stock that was in the over-the-counter market. It's not listed on a big stock exchange. Very cumbersome, laborious process. And as a result, really the only people playing the stock market at that time in the 1960s and prior to the 70s were wealthy people who could afford to have a broker. That's why, and most people were still relying on pensions at that time. The 401k came into being in 1973. And at that point, 1983. Is that right? I get my dates mixed up sometimes. Anyway, more do-it-yourself investing started. People wanted access to the market. So NASDAQ, or an online electronic ability to buy and sell stocks, was created. And that's what NASDAQ did. It provided access to stocks and other assets not listed on a mainstream exchange like the New York Stock Exchange or the Chicago Board of Mercantile or Chicago Board of Trade. It's commonly called the over-the-counter market. Now, here's an interesting bit of trivia that maybe you did not know. One of the early pioneers of electronic trading and making it easier for people to buy and sell over-the-counter stocks was Bernie Madoff. He was actually chair of the NASDAQ for a while. And before he, at least he states, before he started his Ponzi scheme, he was actually legitimately trading, and he was trading in the over-the-counter market, the pink sheets. When he first started, he could not afford the books, the actual pink sheets books. You got to subscribe to those. He could not afford them because he was young and he just got into the business. So he found a way to get bootleg copies of the pink sheets, and they were usually a day or two old by the time he got them, but they were still relevant enough. And he was a big proponent of electronic trading to make it easier to access the market. And unfortunately, some of that activity is what got him into hot water and caused him, led him down the path of starting his Ponzi scheme. All right. So that's it. Those are some technical terms or financial terms, jargon, acronyms that you're going to commonly come across. Does anybody have any others that they've heard or they've got a question about? We do have, I'll stay on for just another few minutes here. I'd love to hear what you've heard. Anything that you might have heard in terms of acronyms, jargon, terms that you would like an explanation on, or just terms you know, but you would like to share with others here. While you're thinking of that, as always, I'll let you know, if you are not yet a member of the ChappelWood family and you're looking for some help, whether that is to review some investments you've got in an IRA and you just want a second opinion on those, or maybe you've got some tax questions, you've got some questions about Social Security and Medicare. I mean, just this week, I've met with clients, and it's only Wednesday. I've met with clients about Social Security. I've been dealing with Medicare questions, long-term care questions, things that are not even related to investing. If you have questions about any of that, you can actually take your phone, open the camera app on your phone, and you can scan that little box code right there, that QR code, and it'll take you to a website where you can request an appointment. And Shelly will get on the phone with you and get you scheduled for an appointment if you're looking for some help. And it's really a phone call first, and it's only about 30 minutes. So I don't see any questions here right now. And I'll tell you what I'm going to do. I'm going to leave this up for just a little while if you're still thinking about whether or not you want to schedule that. But if you need to jump off, that's fine. Our time today is ended. So I'll stick around for a little bit. But for the most part, we're done. So thanks so much for joining us here on the Wednesday Lunchtime Drive Through. Hope that you have a great rest of your day. Stay safe, and we'll see you next time. Bye-bye.